All right, let's dive in. Today, we're tackling a choice that pretty much defines your entire journey in the world of finance. It's a decision that goes way beyond just your portfolio. It really shapes your whole approach to the market. So let's get right to it. The question seems simple, right? But the answer is going to define your strategy, your mindset, and at the end of the day, your shot at success. Are you in this to build wealth slowly and steadily over time? Or are you looking to capitalize on the market's day-to-day rhythm? The best way to think about this is through a simple analogy. Investing, that's a marathon. It's all about endurance, patience, and keeping your eye on a finish line that's years away. Trading, on the other hand, that's a series of sprints. It's about speed, agility, and grabbing those short-term opportunities. Two totally different races, and they need two totally different kinds of athletes. So, over the next few minutes, we're going to break down both of these paths. We'll kick things off with the investor's marathon, then jump into the trader's sprint. We'll also get into the psychology of it all, which is huge. Look at the very real impact of taxes, and then finally help you figure out which path might just be the right one for you. Okay, first up, the long game. The investor's path is all about building wealth. But you gotta hear the keywords here, slowly and steadily. This is not about getting rich quick. It's about getting rich for sure. And who better to sum up the investor's mindset than the man himself, Warren Buffett? This quote just nails it. It's all about passive income. The whole idea is you put your money to work in great companies. And over time, that money starts working for you, growing even when you're not paying attention to it. The really crucial point here is the time horizon. Investors, they learn to tune out all the daily noise, the price swings, the crazy headlines. They're buying a piece of a business they truly believe in, and they're letting the magic of compounding do its thing. Think of it like a snowball rolling downhill. It starts off small, but after many, many years, it can grow into something absolutely massive. So how do they actually pick these winners? Well, they use a method called fundamental analysis. You can think of it like being a detective. First, they survey the entire scene, the health of the economy. Then, they start looking for promising neighborhoods. Those are the industries with real growth potential. And only then do they start digging into individual companies, looking at their books to find a solid business that's selling for a fair price. All right, now let's switch gears completely. If investing is a marathon, trading is a whole different ballgame. This is all about speed, timing, and making money off the market's constant ups and downs. To stick with the sports analogy, this is the T20 match of the financial world. It's all about aggressive, quick, decisive action. Traders are always on the hunt for a chance to score, trying to capitalize on price moves that might only last for a few minutes, a few hours, or maybe a few days. But, and this is a big but, with high stakes comes high risk, and I am not exaggerating. A 2024 SEBI study delivered a really sobering reality check. In the 2023 financial year, a staggering 7 out of every 10 day traders lost money. Now that's not meant to scare you off, but it's to highlight something crucial. To succeed in trading, you need an incredible amount of discipline. So to survive in this kind of high-risk environment, successful traders live by a strict set of rules. A stop loss is like their eject button. It gets them out of a losing trade before it becomes a total disaster. Position sizing makes sure that no single bad trade can completely blow up their account. This isn't gambling. It's a game of very, very calculated risks. And their main tool is totally different from an investor's. Traders use technical analysis. So forget about balance sheets and earnings reports. They are reading charts. They believe that everything you need to know is already reflected in a stock's price and its trading volume. They're looking for patterns, for signals, for anything that might hint at where the price is going next. So now that we know what they do, let's talk a bit about how they think. Because in both investing and trading, the biggest battlefield is often that 6 inches between your ears. Psychology really is everything. This slide right here really gets to the heart of it. Just look at the difference in risk tolerance. Traders are actually drawn to volatility, while investors, they prefer stability. And check out the decision style. It's fast, almost instinctive for traders, versus slow and analytical for investors. Even their emotional triggers are opposites. Traders are battling that short-term fear and greed, while investors are fighting long-term regret and the fear of loss. But here's the thing. No matter which path you end up on, your brain is always going to try and take shortcuts. These are called cognitive biases, and they are basically mental traps that can lead to some really irrational and costly decisions. And these traps show up in different ways. Traders are constantly fighting something called action bias. You know that nagging feeling that they have to make a move, even when the smartest thing to do is to just sit on their hands? Investors, they struggle with anchoring, where they get totally fixated on the price they paid for a stock, which stops them from selling a loser. And then there's a trap for everybody, confirmation bias, that cozy but dangerous habit of only looking for information that tells you you're right. Okay, now let's talk about a very real, very practical difference between these two paths. This whole marathon versus sprint thing, it doesn't just affect your strategy. It has a direct impact on how much of your profit you actually get to keep. See, the tax system is actually set up to reward the marathon runner. If you hold a stock for less than a year, your profit is considered a short-term gain, and it's taxed at a higher rate. But if you hold it for more than a year, it becomes a long-term gain, and you get a much lower tax rate. In this case, time is literally money. So, we've covered the strategy, the psychology, and the taxes. Now for the most important part, which path is right for you? This isn't about which one is better. It's about which one lines up with your personality, your goals, and honestly, your lifestyle. And this really illustrates the trade-off perfectly. Investing is a great fit if, say, you have a full-time job and you want to build wealth without having to stare at a screen all day. It's for the patient. Trading, on the other hand, demands your time and your full attention. It requires nerves of steel and incredible discipline to handle that high-risk, high-reward environment. It's for the vigilant. Ultimately, the choice really comes down to this one question. Do you have the mindset of a marathon runner, focused on a finish line that's years and years down the road? Or are you a sprinter, built for short, explosive bursts of activity? Knowing the answer to that is the first and maybe the most important step on your entire journey in the market.